Thanks so much for tuning into this conversation. Our guest is Andrew Holland, needs no introduction, and it's an important time to get him and his perspective, considering that we are in the midst of some bit of volatility. Monday certainly was. It's a bit of a recoupment of some of those losses today for the world at large too. Andrew, thanks for taking the time out. Did Monday worry you, Andrew? Because the chatter was that it's a combination of higher yields, geopolitics, maybe higher crude prices as well, and not such a great earning season.
Yeah, and we've seen some of those reverse a little bit, haven't we, Niraj? I mean, oil prices have come off from those kind of moves, partly because of, I think there's a lot of diplomacy in the background trying to get hostages out of Gaza, and that's the case. But obviously, Israel at some point will have to do whatever action they feel they need. So I don't think we're away from, that kind of volatility for the oil prices. And of course, bond yields in the US went from 5% just under because of a couple of big names saying, I think Bill Ackman, that huge hedge fund manager, saying, I've now cut my shorts. But what he added of why he cut his shorts is that he expects the economy to go towards recession at the back end of the year. And that's the key. Now, if that is the case, then obviously, the markets are still not factoring that in. So I think this volatility is going to last for us a little bit longer yet. So I think my feeling is that whilst our markets have been, as some people have said, it's become a low beta market. We don't fall so much when other markets fall, and vice versa. We had come to that point where some of the sectors or stocks have kind of run too high, and of course, I'm not saying they're kind of big fall in small and mid caps. It's usually because of liquidity as well. Everyone wants to kind of get out at the same time, and then of course people just sit back and wait for better prices. So, not concerned. Obviously, any correction is a good time to kind of be more constructive, and that's where we would be. I think the only other thing that's kind of catching my eye a little bit more is what's happening in China with the stimulus packages, and now the funds starting to buy into equities. It's starting to stabilize that market. I still think they're using pea shooters where they need to use a bazooka, but if and when they do that, then flows that we're maybe looking towards coming to India might start going towards China, because investors might not like China at the moment, but things change, and if there's opportunities to make good returns on a cheap valuations, then that's where investors will go.
For that to happen, do they need to move from a water pistol to a bazooka, or could it happen with a series of moves that China seems to be doing? Some fiscal deficit hike-led spending, some tinkerings with maybe the reserve ratios or thereabouts. So they're doing a number of small steps. Is that good enough? Or would you believe for flows to meaningfully move away from India and other EMs to China, they need to do something larger?
Yeah, no, they do. They need to get that bazooka out, because the kind of all of these things will add up to something positive, but you can't see it. It's going to take time, and I think if they can do something which is more towards getting confidence back in that property market, that's going to be the catalyst, and that's when everyone will say, okay, yes, we're back into China, and we'll forget the stuff about the kind of technology part, because that's going to be ongoing. But the government's taken action to not just shore up the markets, but also shore up the property market and get confidence back to the China, not just the investor, but to the consumer as well.
Got it. Andrew, so let's wait for that to happen if that happens. But independent of that, Monday, the particular characteristic of Monday's fall in particular for India, I thought, it was accompanied by very low volumes and net FI buying. So the larger problem was at the broader end of the spectrum. Could the HNI stroke retail investor panic a little bit if indeed this rhetoric around the war and higher crude prices, etc. stays? And therefore, could it happen that the Nifty or the benchmarks might be stable with 100, 200 points plus minus here and there, but the mid caps and the small caps, which are up northwards of 20% YTD, see a steeper move downwards? Could that happen?
Yeah, it could well do, Niraj. It's a good point you've made, and what tends to happen is that all stocks are all kind of themes. So let's just say it's a mid cap or small cap. Everyone gets tarred with the same brush. So if you got profit somewhere, you think, oh, it's a big fall in the small cap index, so therefore, I've got small caps. Let me try and get out, and that's what leads to that cascading fall, and then concern over it's going to get worse. As on the way up, that feeling of missing out was there as well. It's a great time actually to do your stock picking, to get to look at the themes that you've been playing. So, for example, electronic manufacturing sector. I've been talking about this one for a long time. If those stocks were to come down, because it's a broad kind of fall, these are the kind of companies where you're just at the beginning of the runway, and therefore, you're going to see, some significant gains over many years. So that's the kind of thing I'd be looking at, rather than saying, that I'd be in that panic mode. But that tends to happen when you kind of hit a peak, it starts to fall, you start to worry about, I'm going to be the last one in, and I'm going to lose money, so therefore let me just take money out. But that said, you still have that $2 billion or 16,000 crores of SIPs coming in, which will, I'm sure will, once, whatever volatility we go through, we'll start to kind of nibble away at the right stocks again.
Okay. Andrew, speaking to 2 or 3 global commentators, read a couple of opinion pieces of people who look at EMs at large from their vantage point. All of them believe that EMs as a bucket might actually be higher from here on till the end of the year because of seasonality, because of maybe peaking of rates and maybe cooling off of yields, maybe DXY coming off as well. I heard you talk about a couple of those things as well, but I just wonder whether you believe, due to all of these factors plus seasonality, that could the momentum be largely in favor of equities for the rest of the year, or is it difficult to predict that?
Yeah, I think it's, you have to get to a point where you get the positives, and so therefore, what are the negatives? Well, we spoke about them at the very beginning, but without reiterating them. I think the one point that I'm still of the view is that, the US and the global is going to go towards recession. I'm not in this Goldilocks scenario of soft landing. I don't remember any soft landing in my time. So, I'm just not going for that. So what you have is that wall of worry, and then, earnings get hit, and then the markets fall. And then you get to the point where, yes, demand is falling, inflation's falling, so therefore interest rates will fall. And that's when emerging markets come in. Now, is that towards the back end of the year or the first quarter? Not so sure. I think it should be towards the back end of the year that narrative starts to play a lot harder. But there's only a couple of more months to go, so let's see if that plays out. But certainly, going into the year, that could be the narrative. Now, for India, we have 2 things on our minds. One is obviously the local elections, which are coming up. I'm not saying that that's kind of what's going to happen in the main election, but that will have investors just watching a little bit closely of what the outcomes might be going forward. And then of course we'll have the whole of the thinking around May of next year and what's going to happen. So we got our own internal kind of things to think about, but overall I still think emerging markets, and Asia in particular, can reduce rates a lot quicker, a lot faster, because we've dealt with inflation for a lot longer. It's a different type of inflation than you have in the US. Once that interest rates start to kind of indicate going down, then I think the RBI can act a lot quicker going into 2024. So more positive in that respect. But of course, there's a lot of things that can happen in the Middle East, which could send, I've seen forecasts, Niraj, of saying that the oil is going to 120. Now, if it goes to 120, it'll have a shock and awe effect, but also will probably participate in bringing the economy down to get back to interest rates falling. So pain trade first, I think.
Okay. Well, then that probably seems to be the problem, that the number of moving parts are always high, just that this time around it seems to be a bit more higher than usual, but maybe that's how it feels every time. Andrew, I heard you talk about looking out for pockets so that if there is a correction, one can take advantage. You cited EMS as one of those. Do the nature of the other winners at large stay the same, or has it changed because of maybe stocks would have rallied, or time would have gone by, or earnings have changed a little bit? So aside of EMS, the other set of winners, do the sectors remain the same? Do the themes remain the same?
Yes, they do actually. I mean, there's defense. I mean, given what's happening, defense is definitely going to be there. Renewables is going to be there. CapEx, the multiplier effect of what the government and private CapEx is coming. But again, with that edge towards those companies which are more geared to kind of smart cities, smart factories, smart something in terms of the CapEx cycle. I think that's where you're going to get better margins. And then, in terms of, spending, I just saw some figures actually, and I looked at them very briefly, but overseas travel between in the last quarter before this kind of new tax, really, really skyrocketed. So therefore, people now feel that they're going to spend more money in India. That's going to be good for the hotels, airlines, etc. So that thing doesn't go away from us. And finally, is that beverages where alcoholic and non-alcoholic are going through that premiumization. And I think we're just at the beginning of the runway there, and I think that's going to be a great earnings boost for them over the next 3 to 5 years at the minimum. So those are the kind of themes we're playing. Now, where does banks fall into this? Banks should be at the top of my list, right? Given that we're going to go to a $5 trillion economy. I think there's still that race to the, I'm not saying race to the bottom, that's probably the wrong word, but this race to get deposits and NIMs, it showed up in all of the results that I've seen so far. And I think, whilst I see the reports trying to walk through it and say it's okay, but every management said it's not going to get better. And I don't think there's a catalyst yet for the banking sector to move a lot higher. And I think that's what's going to hold the market back.
So just wondering, before we wrap up, Andrew, a follow-up to that particular point, do valuations at 2.3, 2.2, 2.5 times price to adjusted book take care of that lower NIM narrative? Or as NIMs go down next quarter and possibly the quarter after, we may see some more softness in the private banks?
That's my expectation. At best, it's probably going to stay where we are. And the other thing I'd mention, Niraj, just on the banking sector, is that the RBI has said a couple of times now we're concerned about unsecured lending.
Yes.
And maybe they're going to do something or mess around, or not mess around, work around that by having higher ratios for the banks to deposit with them. And again, what would that do? That would slow down your loan growth. As well as your NIM contraction. And I think that possibly is what the banking sector is telling you is going to come.
Got it. Andrew, always a delight to talk to you. Thank you for giving us your thoughts on a number of moving parts, and have a great remainder of the week.
Thank you, and always my pleasure, Niraj.
Thank you. And viewers, thanks for tuning into this conversation. I'm sure it helped. Thanks for tuning in.